And I'm going to hand it over briefly to Lisa and Amy, who are our AMPM co-chairs, just to welcome you. And then I think they're going to pass it over to Patience to set the stage a little bit. We'll hear from Peter and Lauren, who are also on the call, and then David with OIC has prepared a presentation for us. And with that, I will hand it over to Lisa. And Amy.
All right. Well, welcome everybody. Thanks again for joining us for another exciting asset management, property management affinity group meeting. We've got a packed agenda today, so I don't want to take up too much time before I turn it over to Patience. Second month in a row that we have quite the packed agenda. So thank you again to HTC and to our guests today for preparing this for us. It is a timely topic. Go ahead, Patience. You are welcome to begin.
Thank you, Lisa, and welcome everyone to the Asset Management and Property Management Affinity Group. Lisa and Amy do an incredible job keeping this group in partnership with the affinity group members really focused on top-tier priority issues, and that's really appreciated. But for today, we are going to dive into a critical conversation on the affordability and sustainability of property insurance. We continue to see rising costs and limited availability of property insurance, which we all know is it's a significant barrier for housing providers today. And in our conversation, we're going to just examine what the barriers are, and just with a little bit more context, the state provisoed last year, they dedicated resources for a study on what is happening with the housing trust fund portfolio, laying out those barriers, but also developing very specific recommendations. And in December, the OIC did publish the market study report that you're going to hear about here in this conversation, with very specific analysis of what the issues are in the market, but also pointed recommendations on what we can do. And I think there's some critical areas that we're likely going to dive into, from how do we reduce the total cost of risk in properties. There's been discussions in the past about what does a risk mitigation fund look like that can proactively support providers. And then there will be questions around how do we increase the availability of insurance? Is there a role that the state can play? We're seeing states like Florida stepping in differently in their own markets. What are some mechanisms that we keep moving here locally? And then I think for me, top of mind is how do we develop a strategy collectively as the housing sector in moving these very specific recommendations forward. The work has been done, the report is out there, but how do we keep the work alive? And one of the steps, I'll put a plug for this proactively, that I have in my mind is, from this conversation, we should be able to come out with an idea for a collective letter that talks about the recommendations that have been included in the study, but also keep this work alive in front of the legislature, continuing the coordination with OIC. We know it's a difficult budget year this year, but we've got to start moving the dials for this work to actually gain traction and move forward. So we've invited Commissioner Kudura. She could not join us today, but we do have David with us, who's going to talk through the market study findings. We are aiming to not just make this be about understanding the problem, because all of you are on the front lines of the problem. We're aiming to make this more solutions-oriented conversation on how do we uniquely position HTC to support all of you and advocate together for solutions, and how do we shape that strategy proactively now in thinking about the critical voices that are here, but what other voices do we need to really get this work moving forward? So we've invited our board members. We have Lauren from LISC, Lauren McGowan from LISC on the call. She's our board member, as well as Peter Tran from Lockton. They're going to help facilitate the conversation. So I'm going to hand it over to them to provide a little bit of remarks before we kick off, and then they will help us move into the presentation as well as a panel discussion. So over to you, Peter and Lauren.
Thanks, Patience. So Peter Tran, Lockton Companies, new board member for HDC, extremely excited to be part of this group and help kind of navigate these rough waters that we call insurance. David's on the call, and I have gone through the market study. It's pretty comprehensive, and we'll hear the presentation from David, and we do have some questions that we've kind of put together that we'll ask the group. And like Patience said, I think it'll be important for us to learn from each other as to what some of the levers are that you all have deployed to manage insurance costs and overall risk. But yeah, we think it'll be a good conversation, and excited to hear David's summary of this report.
Thanks, Peter. Hey everyone, Lauren McGowan, Executive Director of LISC, and excited to be with you all today. Major issue, really appreciate everyone taking the time to dig into the report and for us to all work collaboratively in the coming months and year to think about both policy and practice solutions that can support the work. At LISC, we're looking both in Washington and around the country at different solutions and different ways to address this really critical issue, and just look forward to being your partner and helping to inform the other HDC board members and network of providers around what we should do, what actions we should take. So looking forward to digging in today.
Is that my cue? Am I up?
Good way.
Okay. Hello, everybody. I'm David Ford. I serve as the Senior Policy Advisor for Property and Casualty at the Washington State Office of the Insurance Commissioner. And I am very happy to be here today, and I am sorry that Commissioner Cooter was unable to make it. She's traveling, but she wanted to be here as well. She finds this topic incredibly important, and we know how critical the work that you guys do is to our state. If I could, I'd like to share my screen. And let's see if I could find that. Okay, and then also really quick here, I'd like to post in the chat the link to our work group. So in there, you'll see recordings of the work group meetings and other documentation that you guys can look at when you have time. So I just kind of level set a little bit about what we do at the Office of the Insurance Commissioner. We're going to talk about a whole bunch of different insurance markets today. And I think it's really important to understand that the insurance market isn't one. It's many, many different kinds of insurance. So at the Office of the Insurance Commissioner, we regulate very, very closely authorized companies. You may hear them as admitted companies. For these companies, we review policy forms, we examine rates to make sure they're adequate, not excessive, and they're not unfairly discriminatory. And we do solvency requirements and financial examinations. And so the top layer is highly regulated. It's the companies that most of us deal with for our personal lives of homeowners and auto and renters, and then small business owner policies. And we have commercial policies that are in the market. And then we have something called unauthorized companies. However, we call them surplus lines or excess and surplus lines companies. They are not regulated in the same manner. We kind of view them as our safety net because they will take on the risks that the top layer will not take. And so they're super important for our insurance ecosystem. To be able to access this market, you do have to use a licensed surplus line broker, and we have about 4,000 of those in the state. They do have solvency requirements. They are not part of the state guarantee fund, and we do not review or approve their policy forms or what they charge consumers. There's another market. It's local government, quasi-government entities, nonprofits doing quasi-government work. These are risk pools. They're not regulated at all by the Office of the Insurance Commissioner. They fall under the regulation of the Office of Risk Management and our state risk manager. And many of the entities that we were looking at over the summer and the fall fell into the risk pools. Not all. We had some that were with this surplus line. We didn't have any that were in the admitted market. And then fourth, there is also risk retention groups. In another market very similar to what we're going through in the mid-'80s, the federal government created this type of an entity. It's a federal creation, so there is no real state oversight of this market. We can't reject them, or there's no solvency requirements. Of course, we don't review any of their forms or what they charge their members. And you know, really, I need to update this because there's a fifth one. There's captives. That's a whole other insurance market that's really starting to come into play. And our study was really narrow. So the legislature, as Patience mentioned, asked the OIC to look at certain type of housing providers, and these are folks receiving housing trust funds and then serving extremely low income households. So we had to work with the Department of Commerce for ourselves. We're not experts in who these entities are. So we had to work closely with Commerce to try to identify who are we going to be looking at. So we knew how important it was because we watched all the testimony around the bill, and we learned a lot about what was occurring for these folks, that the market had shrunk. So companies that were providing coverage are no longer doing that. They are also increasing premiums drastically, not marginally, just double, triple in some instances. And then on top of the increase in pricing, there were also kind of decreasing coverage. And so whether it was folks having to retain higher deductibles, and if you don't know what a deductible is, that's the risk transfer of the policy that affects the consumer or the buyer, the insured first. So the first dollar of any loss is actually yours that you have to pay. So the higher the deductible may mean cheaper insurance, but it's a risk shift where you hold now more of the burden. And then sometimes they just wouldn't provide enough coverage on the liability side. So instead of having one or two insurance companies, you're having to get 10, 12, 15 companies to fill in the gaps that you need. And, you know, we understand that the operational budget is very tight. So the dramatic increase in the cost comes right out of that operating budget. And then also, if you have a very high deductible, that is money that you have to pay first. And when I mean high, I mean there are some folks out there that were doing 250,000, maybe higher. I know Flo's here, and I can't remember exactly, Flo, what you guys were at one point, but that's a problem. So we headed into the study knowing these things were happening. So here's what we did. So first, we had to start understanding operationally how these providers operate, what contracts they're working under, funding they're receiving, what the properties look like, what the folks, the tenants, what was happening there. So we did tens and dozens of one-on-one interviews. Going through the Department of Commerce, we had a list of who they identified as these folks that were serving these extremely low incomes, and then they participated in a voluntary survey. We had really good response. We were really happy with the folks that participated there. And then we do something regulator to regulated entity is what's called a data call. So it's like a request for information, but it's very specific. We will send out Excel worksheets with data cells that need to be completed. The legislature granted the OIC extended authority to collect this certain data. As you may remember, that stack of different types of insurance markets, well, we have different regulatory authority to collect data from them from each layer as well. The legislature granted the OIC authority to collect data from any entity that provided coverage to these identified folks. And we had good participation. We didn't really have anybody try to legally challenge us. There were some folks that didn't quite fill out everything perfectly, but pretty good responses. We also looked at what's happening elsewhere in other states, and then OIC, we're not trained for this type of work. Our actuaries are doing other assigned jobs. So we hired an actuarial firm and another policy-related firm to, they had data confidentiality agreements, so they were able to dive into the data that we were able to provide them and dig into the numbers and work with us to provide the recommendations at the end. And then the goal was to try to figure out the total cost of risk. This is all encompassing, and if there was a way to reduce it through different policy options, then there could be short-term reactions and then mostly long-term. So in general, there's a couple things affecting your market. One is stuff that we cannot control. These are just global, national economic pressures. You may hear the term hard market. This is cyclical that happens in the insurance industry. I said that there was one in the 80s, there was another one in the early 2000s, and we're in the depths of one right now. And in general, what that means is that there's a pulling back of insurance entities. There's less capital available to them, and therefore they are reducing their book of business. Sometimes they're shuffling their accounts to try to hold a better hand than they did. So it often includes folks being non-renewed, canceled, and for the folks that they would offer coverage to, there is a higher standard of underwriting, and we're in the middle of it. What's causing it? Well, insurance is kind of a lagging economic indicator. So what's really interesting about this hard market that's different than the previous hard markets is the property issue. So we've had hard markets in the past, but they've always really been left in the liability side. For folks that don't know, liability is the coverage that will defend you if you've been accused of causing property damage or bodily harm to somebody else. But this hard market is also being driven even more on the property side. So for the insurance industry, they are dealing with more and more billion-dollar events. So single events that are costing billions of dollars on the property side. And we believe at the OIC, climate change is a big driver of that. It's happening all over the world. So there are entities called reinsurers. These are massive global entities, and they actually provide insurance to the insurance companies that you and I deal with. And for years, they have been trying to pay out this increase in global property damage. And it has caused them to, well, they just don't have enough money, and to be honest, and so they are pulling back with the amount that they could offer our primary insurers, and that caused solvency issues to our primary insurers. So that's a big contributor to our hard market. There may be signs that it's stabilizing, so that is a little bit of good news. Inside Washington, as I said, that insurance is a lagging economic indicator. What is causing prices to increase? So I want to share with you a concept, just as you kind of think through all these insurance related issues. The availability of insurance is driven by the risk, more so the perception of the risk. So availability is due to the perception of the risk. The cost of insurance, though, is directly tied to the cost of claims. And so insurance companies must have a pool of funds available to pay off all of their obligations, all of their policies. And as things got more expensive to repair and the cost of things went up dramatically, they did not have enough money in the pool to pay for their obligations. And so the only way they can collect that is through premiums, and that's what you pay to have insurance coverage. So in Washington State, almost every line of business, their property claims has doubled in just 5 years. So that's what's driving a lot of the cost of increase, is the increased cost to pay claims. Now, specifically, what we uncovered with what was happening for some of these housing providers was a kind of a two-pronged issue. So for the older properties, these are the wood frame construction, the old roofs. They didn't quite have all the modern safety issues. There were many companies and then reinsurance companies above them that didn't want to cover that. And then for new properties, if they're appraised for more than 10 million, many entities would not cover more than 10 million in a single property. So that's a problem for many of your homes. Many of your property sites fall into those two buckets. Profile of the residents was an issue, but it's something that's known, really. So there could be a fear, a perception of risk that may drive a little bit higher insurance. And if you think about the some of the behavior issues that may happen, it affects the property side too. If there's a sprinkler event on one of the top floors, it goes down through multi-floors and it causes a property issue. Many of the things we heard from the housing providers was great appreciation for the majority of their tenants. They were really concerned about one or two, and that maybe they had a difficult time trying to remove, and because they felt that this one or two individuals were harming the greater good of the community. And we heard that multiple times. So we kind of talked about availability and affordability. So you have to understand insurance is for profit. If they can't find a insurance model that is profitable, they are probably not going to want to stay in that marketplace. And so what we tried to look at was long-term methods to increase affordability and availability. So how do you do that? How do you, on the property side, you want to modify, as I said, the cost of claims. So what are ways that you can do that? Well, you can change the frequency of the losses, so you just don't have as many. Or you can try to change the severity of them. And of course, it's best if you could do both. So we tried to look at some of those ideas. On the on the liability side, it's a little bit more difficult because now you've got to really, to change that environment, you've got to institute some things that are pretty difficult in our state to really do. And that would be to try to put some type of a limit on what's recoverable. Very difficult to do. What I've seen occur more often, though, is to reduce the negligence standard around a certified individual. So I've seen the state do that more than a couple times recently. And so we try to express that kind of an idea. The last kind of thought is for government involvement. And patients mentioned something that's happening in Oregon. I'd love to learn about that. We're in the middle of our ledge session, so I'm pretty focused here on what's happening in Olympia, but there could be some government assistant programs, maybe expanding the trust fund availability to cover operational costs or mitigation products and those type of things. So to get to where you guys want to go, talk about is what the report kind of fell on as 12 different options. Again, that TCOR is the total cost of risk. It's a thing that we kind of tried to categorize. So 1 and 2, what are 1 or 2 talking about? It's that reinsurer concept of you're kind of inserting yourself into the insurance role as a government or as some other type of fund. But really, it's in our state, it's probably only the state government that could have the resources to maybe do something like this. So what is the driver of the property insurance crisis? We kind of deduced it was the severity. Because people are raising their deductibles to take on the frequency issue, so the low cost, many claims. It is the catastrophic severity claims that the risk managers of these organizations are most concerned about. So there is an idea that that you can create a public reinsurer. So on top of these risk pools, because the far majority of the housing providers are using risk pools. But it could also, we could try to make it available for the folks that don't. But there is a government entity on the top that takes care of claims after they reach a certain threshold. So that's the concept of number 1. Number 2, though, is kind of flipping it upside down. So if the pressure is really on the frequency, low cost frequency, then you would create some type of a government entity at the bottom. And then once a claim was to go through that window, then insurance would kick in. So insurance wouldn't have to cover, it would kind of act like how some providers are treating their deductible or their self-insurance retention is maybe something you might be familiar with, a different term. So the other concept would be some type of reimbursement fund, whether it be through some government program to try to give access to the high deductibles that we were seeing. Now, kind of the most holistic thing to do is to try to mitigate, try to make it so either the physical components of the property can withstand not turning into claims. And so, you really have to think about what's your claim profile. Is it kitchen fires? Is it water damage? Is it sprinkler systems? And then really trying to attack that to minimize, if something occurs, the spread of the damage. So I know that we talked to some folks that were looking into fire suppression under a range hood, or water monitor systems that are tied to the main valve. So if they sense a leak, it stops to try to stop the spread of a water damage. Sprinklers are tough, right? State fire marshals, they are really strict. So I don't know what it could be opening a conversation with your local fire marshal to try to figure out how do we protect against a broken sprinkler head, because that's going to release a tremendous amount of damage. And then, the same as we're talking about on the physical side, is there a way to mitigate maybe more, is there more things that can happen to help behavioral risk in the properties with the tenant? So again, the whole idea there is to try to figure out ways to reduce the total cost of risk. Number 6 is a little interesting because your tenants, they don't have renter's insurance. So normally what would happen in a normal commercial property that had renters is the renters would have their own insurance, and their insurance would provide liability coverage to other people and the property owner. So if that tenant was responsible for property damage or bodily injury to another, they could receive payout from that source, but also there's a subrogation component that the property owner could subrogate back, meaning try to seek the recoveries that they paid in their own insurance policy through the renters. And since you don't have renters, there could be a concept of creating a public renters insurance program. Again, this would be a subsidy from state dollars, so very difficult in today's climate, but that could be a different mechanism to try to make insurance more accessible, because you're changing the perception of the recovery risk with that. So 7 again is kind of 7 and 8 kind of go hand in hand, really trying to figure out ways to reduce risk. Again, you could try to increase building inspections to try to help with electrical and fire and roof leaks. So you're catching situations earlier before they become a damaged loss or an insured loss. Building codes is really going to help with the perception of it too. If the insuring entities and their underwriters know that this building meets a higher standard than a normal building, that would be a benefit. So 9 is going to more funding for social programs that could be administered in partnership with the housing providers. This again is trying to reduce risk. That's the theme of this whole thing. 10 is just straight up subsidize the cost of insurance. So again, this would take government money, but it would, we're trying to figure out ways to allow insurance to stay in place, but not to affect the operating budget quite as much. 11 is kind of what I was talking about earlier. So what the state has done in a couple different instances is if they found that there was a space so critical and necessary for it to function, they created a certification around it, a higher standard of training. And in return for this certification, they remove the ability to be sued for carelessness. So to be sued, you would have to have some intentional or willfulness, gross negligence standard applied. A couple that come to my mind, because I'm in insurance, is a prescribed wildfire burn. There's something called a certified burn boss. So DNR created a training program to certify someone that does prescribed burns, and in doing so, they could not be sued if their burn goes out of the plan that was approved on and trained for. If it was to leave that, they could not be sued for carelessness. And so there's another one for behavioral health crisis responders. So this is, I mean, I think I've seen it for wetland mitigation contractors. So this is not new to them. It is, you have to think about the other side. If you're changing liability standards, well, you know, somebody was harmed, right? Or there wouldn't be a damage claim or a lawsuit. So you have to really be thoughtful about proposing something like that, because you know, the legislature and people of Washington State want harmed people to be made whole. But really, probably the most effective thing would be to start combining options with the goal. So you have a short-term goal of getting through the crisis, and then the long-term goal of reducing the total cost of risk. Because in the long term, that would make your line of business more attractive to the market. If you can get the market back engaged, then you get price competition. And in the long run, it would be the best pathway, operational cost-wise, for you folks. So I think that's it. That's all I got. If you happy to start the discussion and see where it can go.
Well, thank you, David. And Peter, I think this is the part where we'll hand over to you for the conversation. But David, for the layman here on insurer and reinsurer,
Yeah.
I mean, I'm seeing that as an intent to transfer risk for the reinsurer to the state, and analyzing the two options, which one were clearly higher impact between the two, the insurer and the reinsurer option? Which one addresses the issues at hand effectively?
Well, there are different costs, definitely, right? So one, you're kind of looking at a catastrophic level cost. Reinsurance cost is very expensive to the risk pools. So if you were to have the state act as a reinsurer, it would reduce the cost of everybody's in the risk pool's insurance. If you were to ask the state to do the first dollar, it would be tough to determine what would be the appropriate level to have the insurance entities then come in. So would it be at 100,000? Would it be at 50,000? Very, very difficult to know. So I'm sorry, I don't have a clear answer for that. They're both just different tools in the tool bag.
So David, I might expand on maybe I think where patients might be going with this is, so in your study, you mentioned severity versus frequency type of losses. And so to your point, right, if you're looking to insure it from a reinsurance level, so the group kind of understands, right, you're talking about insurance for insurance companies, right? So the primary insurer would take up a layer, call it $1 million of coverage. After $1 million, then they buy insurance for themselves. That's called reinsurance. So I guess to maybe expand on patient's question is, okay, and it would be important for the group to know, maybe in the study, did you evaluate types of claims and what types of claims and payouts were part of that severity and frequency study? I mean, did you gather loss data that would indicate that more of the losses are coming at above $1 million, or were they more attritional type of losses, kitchen fires, $100,000 backups and water damage type of claims?
Yeah, that's a great question, and I'm trying to remember, and so I'm skimming through it. I know that when the actuaries looked through it, they didn't notice that anything was being overly charged. That actually, in that market space that we looked at, the total annual insurable losses was between 11 million and 14 million per year. So it turned out to like a total cost per unit between 1,500 and 2,000. I don't remember any comment from them whether it was driven by high frequency, low cost, or low frequency, high severity. They did say it was kitchen fires, water damage, sprinklers, frozen pipes. That was a huge one because in one of the periods we were looking at, we had that February event that many broken pipes occurred.
Yeah. So I guess it'll be important to unpack that, I think, and this is just my opinion, is so if you're contemplating whether you want to ask this group to go and advocate for, the funds to be a public insurer, right, which would be for that first kind of $1 million or whatnot, right, versus reinsurance, right, where it's the higher severity, claims that, out of that $11 to $14 million of losses, if they were big, wildfire claims that resulted in a $2 million loss, then yeah, that would go into the reinsurance layer, right? So I think the question might be, how can we evaluate that data to determine whether or not it makes more sense to be a public insurer or a reinsurer?
I talked a lot about government funding, and I didn't really talk at all about where that funding could come from. So a couple things that the report identified is redirecting premium tax. So the OIC collects premium tax for the state. It's about 1.8 billion for the biennium. Now, we don't have any control of where the money goes. That's what the legislature does. But we do collect that much, and we hand it over to the Treasury. There's another tool that policymakers could consider is adding a surcharge to other lines of insurance. So if we're talking about commercial property, and it would take me a minute to pull up what the total premiums are for the admitted line. But there could be a surcharge on each policy redirected to a fund. And then they could, if you could think of another tax or a fee that could be created. But those were some that the study kind of saw that maybe could work. It's not good that for the regular insurance companies that operate in the state, they would consider that an additional tax that is unique to Washington. And so there would be market pressure if the fee was enough that maybe they wouldn't want to do business in Washington anyways. I'll say though, for your housing developers, they've kind of already made that choice for you. So it's really, that's why the policymakers kind of in the state have to decide if they're willing to create that additional burden on insurers that are participating in the state, but not for you, that if they could participate, that they would be feed or have a surcharge. And to be honest, really, it would be passed through. So it would be the insureds of those commercial properties would be paying the additional cost.
So, well, we've got a couple of questions, and I think it'd be good to kind of open it up to the group, right? I think that I go back to what Patience had mentioned earlier, right? Is it's great to understand what's happened in the marketplace and how we got here, right? And it's thank you for that market kind of update and give that color as to how this hard market has come about. I think what we want to try to do is find some solutions, right? What levers can we pull? And with this group here, I think what we've done is we've prepared a couple of questions, right? Not necessarily for the OIC, but for the group in general. And so one of the questions that we came up with is how are we responding to the tenants that are causing damage, right? Whether it's behavioral health or whatnot. Yeah, the study does go into losses and how that impacts the overall cost of insurance. And so if there are tenants causing damage to the property, I think that's we'll open up that question to the group is how are you dealing with those tenants? And obviously there's things that are in place that make it difficult, right, to either evict or manage that, whether it's behavioral health or whatnot. But obviously risk management and controlling that particular tenant will be key. So I'll just open that up to the group. If there's nothing there, one of the other questions might be, you mentioned deductibles and higher deductibles as being an issue. Another question might be for the group is how are we dealing with those larger deductibles? And are you seeking waivers with your investors? Are you paying it out of corporate funds, operating expenses? Got some comments in the chat. Look, it's an issue, definitely exists. Just not sure how anybody has answered a great answer to manage it. Some are just paying it, right? By trade, I am an insurance broker, so I might throw a couple of ideas out there for you all, because David in his report does present a pretty challenging aspect, right? So the insurance companies are reacting to this market, and so they're trying to attach at a higher level, whether that's 100,000, 250,000, whatnot. And so what we have seen, right, as a strategy behind the deductibles could be a couple of things. A, you're asking, it's a component of, hey, are you in compliance with your investors and lenders? So in some cases, we're asking for waivers. Now, that doesn't solve the problem of having to pay a higher deductible, but it's more of a compliance thing. Some of our clients or insurers or developers have opted to pre-fund for those losses. Okay, so now that's, again, doesn't solve the higher retention, but it may solve a cash flow problem, right? So using actuary data or loss trend information, what you could do is pre-fund for those losses and create a reserve fund to pay out deductibles. Okay, and now that may very well could be where the state funds will come in, right, to help you pay for those losses below the high deductible. Potentially, that's a solution. The third option that we've seen is you actually go buy that deductible down with an insurance product. Okay, so if your primary carrier has a $250,000 deductible, what you could do is buy an insurance policy to buy that deductible down to a more of a maintenance deductible of 25,000 or 10,000, whatever it may be. Now that increases your total cost of risk, right? But at least it'll create a situation where that cost is fixed and you know what that is, and you're buying insurance to buy it down.
Go ahead, Amy.
Sure. I just thought I'd weigh in and share some of what we've got going on the east side. Peter, in response to your earlier question, I think we can all share that evictions are hard and addressing the behavior challenges that are issues that come up that could lead to property damage have been difficult due to the court system. And, I think we had one instance where we had a pretty good case and, months went by to the hearing, and we had issued one incorrect notice that kind of ended the whole the whole thing. So it's really a little bit more challenging, at least right now. I don't know if things will change in the future, but to address certain tenant issues, not impossible, but just challenging. I think where my mind goes is with how do we design and retrofit buildings to try to limit risk regardless of how tenants behave inside of their units. So we've had a couple of large losses, broken exposed sprinkler heads that have been broken, or during the power outage, if there's a freezing event and power outage, depressurization of the sprinkler, leading to some water damage, which could have been addressed if it was kind of identified ahead of time. So those are just some examples. I know there are other organizations that are facing more challenges than we are with insurance. We went from $25,000 deductibles. The worst was the $25,000 per unit water damage deductible that we had at one point. We're now down to $5,000 miraculously, but we're trying really hard to limit our claims. So I think I love the idea of maybe providing subsidy, especially for the providers that are having the most challenges. But I think to be good stewards of public funds, if we do that, we really need to be thinking about on the front end about how we reduce the amount of claims and the amount of damage, so that we're not just, creating this like enormous need to, to pay out lots of money that's not going to be sustainable. So.
Thanks, Amy. I think that's a great point, right? I think you can't be an endless ask of money, right? And I think that if we can look at data and loss trends and be good stewards of that money, I think it'll be a better long-term solution. I did borrow some information, and I could share it with this group afterwards from our loss prevention folks in regards to actual physical risk mitigation tools and things that likely many of you are already using. But when it comes to water damage, replacement of rubber and plastic water supply lines, right? That could range from $10 to $15 a unit. Low temperature alarms for vulnerable areas, right? Thermographic scan of building and envelope roof, right? And when it comes to fires, I think it was mentioned earlier, fire stops where there's an agent over the stove that puts out the fire, right? The cost of those are $40 to $70 per unit. So, could there be some subsidies that are used to improve risk, right? That at the property level that will ultimately reduce the cost of insurance, right? By having less claims and improving risk at the properties, I mean, that is a strategy that has worked, right? So outside of that, David, this might be a question, and I think you brought it up too. In the study, you talk about some of the other state agencies that have gone down this path in various different forms, right? You mentioned Oregon. Obviously the California Fair Plan is front and center as of late, right? And so just curious as to if we were to go down this path, what can we learn from other state agencies, whether are these programs solvent? What can we do differently here in Washington that would create a solution for affordable housing owners and developers long term?
So we do have property insurer of last resort in Washington. We have a Washington Fair Plan. I think that the limit for that, though, is only 1.5 million. I don't know off the top of my head. I know in California it's 20 million. And so maybe an expansion of the Fair Plan might be an idea. But I can share with you that the Fair Plans do a great job of making insurance available. They don't do a great job of making insurance affordable, because even in those models, they have to be actuarially sound, meaning the amount that's paid into them has to be able to produce the pool of funds necessary to pay the cost of claims. And what our actuaries found is that the pricing is accurate, so for the risk. And so if you were to create a new fair plan model for your line of business, it would make it available for insurance is there, but it wouldn't change the cost. And yeah, I'm sorry, I just don't know what Oregon's doing. So hopefully something good we could steal from them.
Oh, I appreciate that. Yeah, I mean, I think you make some good points, right? I mean, I think that the example of the California Fair Plan, right? They've, some of the initial reports are that they've got, somewhere in the range of $300 million in surplus to pay out claims.
Yeah, something different. That's going to pop. That's going to become insolvent. And then what happens is there becomes a market assessment on all the insurance companies in the state. And that's going to cause more disruption in California. I will say though, and I don't know about, because the entities that you work with, these risk pools, they're so uniquely in a bubble. For our regular insurance entities, they can't use outside Washington experiences in their rate making. So what happens in California and in Florida and in Texas has a little bit of an impact on Washington costs because of reinsurance, but it'd be interesting to know. I know some of your risk pools operate in 4 or 5 states. And so the experiences that happen in those states do bleed into your risk pools. But again, I think Amy's idea about using public funds to create risk mitigation, I think that's a very good pathway to have a policymaker agree with that idea. I think it's well known that $1 of mitigation saves $7 to $8 of damage on the other end.
Lisa, did you have a question? Go ahead.
Yeah, here, I'll lower my hand. So, I think a lot about how expenses have increased. And one of the things I continue to see with new deals is that the replacement reserve deposit requirements have not changed or adjusted related to the cost of expenses. So back in the day, 10, 15, 20 years ago, $350 a unit a year might have been enough to save for a rainy day. And then the theory had always been, well, gee, after year 15 exit, you can roll it through another LIHTC resyndication. And that option is no longer available due to bond cap limitations. So we're really struggling to figure out how to recapitalize properties without the impact of insurance. And I know that a lot of our public funders are in the room, and I've said this before, but I think if we set our projects up for success and in the pricing of our brand new projects or in our resyndications, adjust for the reality that replacement reserves aren't just for the roof that's coming due, or the common area painting, or the next time you need to do windows, that these funds are often utilized for exactly what we're talking about here: saving money, not doing an insurance claim, paying the deductible on the claim. And so I don't know how else we are supposed to address the longer term capital needs if the intent of those funds is being kind of willed away by the day-to-day reality. Not going to solve everything, but I think, especially for our existing portfolio, but I think the more we say how important this is in funding new deals, the more we set our projects up for success.
I know we have public funders on the call, and not to put anyone on the spot, but that might be worth noodling over. On what does policy change to that look like? It's a director level change as far as I can think about it. But Jackie, you're on the call. Anything you would want to comment on that?
Yeah, hi, Patience and everybody. Jackie Moynihan over with the Washington State Housing Finance Commission, listening in and been tracking this. So thanks, commissioners, the Insurance Commissioner's Office for the study too, and this conversation. So Lisa, yeah, I'm glad that you brought that up because I think consistently, you know, we're even talking about how much preservation is just as important as new construction, and we really need to be thinking about what are the different tools and maybe thinking about things a little bit differently. So I do really appreciate you bringing that up in this space, because I think a place that certainly sticks out for me as we think about preservation is really the mitigation component. So I think, you know, no real answers, but I guess I can say that as public funders, we are having conversations about like the need for preservation, the need for maybe thinking about things a little bit differently. And that could include some different ways of thinking about things like reserve replacements and stuff like that. So I think just probably more to come.
And I think on the mitigation fund idea, I mean, we have legislative champions who we know have also floated interest in establishing a mitigation fund. There is the repair fund that's out there now, and that's a question too for the providers here on how well is that working, and is that an opportunity to expand on a path to a mitigation fund that's specifically for affordable housing providers. I know that we're rolling out applications at the start of the year. Unsure if that has actually happened, but if it has, it'll be helpful to know how well it's working on the ground. Response is not yet, still not yet rolled out. Go ahead, Amy.
In terms of mitigation, and honestly, we haven't explored this for insurance. Another kind of issue that's becoming more, a little bit more of a problem for us is mitigating drug contaminated units, because those exceed the $5,000 threshold by quite a bit typically, and we're trying to figure out how do we do that safely, effectively, but also cost effectively. And there's resources that, you know, it's hard to find resources for that. Investors will say we can't use replacement reserves for that. That's not what those funds are for. Insurance may not be the best option, and then the mitigation fund, and if it's happening in the property that doesn't have a lot of other resources, it's a challenge. So that's kind of a newer issue that's coming up for us, and yeah.
Yeah, Amy, I don't know. I'll maybe comment on it. I think that my understanding is that there is a level of contamination to the units. If I'm just assuming that you're talking about meth contamination and usage in the units. We have seen from on the insurance side, the claim side of things, that there is a percentage level of contamination that requires you to gut out the whole unit. And yes, oftentimes it can be a very large claim. There is insurance to respond to that. Typically, we have seen some of those cases get covered under a pollution liability claim. So just something to look at. But again, that just adds additional cost to your insurance spend, right? But yes, from what I gather, there's a lot of discussion around the level of contamination in the health department and who gets involved in whether you need to tear down an entire unit and the entire HVAC system and the whole building system, and hundreds of thousands of dollars later. So it is something that we have seen and we're aware of. And my understanding is that the health department kind of comes in and measures that level of contamination, and it's not very high, right? I think some of the studies that have come out have shown that it's very little contamination where it can cause long-term problems.
You just scared me, Peter. You mean it gets worse than just in the unit? If they do this in a larger building, it impacts the whole like air system. Oh my gosh. Wow. Thank you. I needed more good news today.
Again, that's some of the things that we've seen with the way that these buildings are designed today, right? I think the idea is that the contamination gets into the systems, and if you've got a central system, it gets into other units, and that's when the claim gets into the large numbers. Well, patients, I think that we kind of went through the kind of set questions that we had for David and the group. We're happy to unpack in further sessions. I think that it sounds like, just based on the conversation today, there's a lot of interest potentially in risk mitigation, and further maybe in future sessions we can invite some folks in that are loss prevention experts that can speak towards specific strategy and tools and cost associated to mitigating risk. It seems to be backed by the market study that the OIC has published. And so if there's interest from the group, then I'm happy to help coordinate that as well moving forward.
Yeah, appreciate that, Peter. A couple of things at top of mind for me, which are coming out of this conversation. We should plan on sending a letter to the legislature, one that's acknowledging the work that David and his team have done, the work that the legislative champions who've sponsored this work have done, but more importantly, to keep this in front of the legislature as a next step. And we've gotten some outreach with questions of what's the value, right, of the recommendations. So I think that's a natural next step for us all to come together, have a letter with the organization signing on to demonstrate the value of what's in the study and the recommendations and move that forward. But in doing so, the question that I have for the group is, what of the recommendations is really top tier, high impact priority? And David, this is where your expertise can also help us think proactively on what we would push for if we were thinking about the next 2 years. Because I think of this as there's got to be some short-term and longer-term pathways. And what's in the 12 recommendations is in the next 5 years that we push for. So if we can go back to this last slide with the recommendations, I took a snip of it too, David, if you don't have it handy. But just for us to talk through what of these 12 is top tier for emphasis if we're moving forward with that letter.
I think I can pull it up. Just one moment.
Super. So what I was hearing earlier, and this was in some of your reflection, Peter, on the public insurer versus the public reinsurer. It sounds like they both need resources. They both have value. But if we're going with the upfront cost reduction or sustainability for providers, it could be that we're emphasizing the public insurer first versus the reinsurer, just floating that for a gut check in the room.
Well, if I could, following up on Peter's inquiry about the study, Peter, they didn't have access to all the providers' self-insured payments. So that's probably why we didn't have any type of comment on whether it was low frequency or high severity. So I just wanted to throw that in for your consideration of why. Go ahead. Sorry, patience,
Yeah.
didn't mean to interrupt the question.
No, I think that's a good clarification point, David. I think that, look, this is above my pay grade, right? When you talk about creating a self-insurer or a public insurer or a reinsurance company, right? We have folks here in our firm that can chime in, but my guess is that to help patients kind of guide this process to the folks that will be looking at it. I think that loss information or that piece of data component of loss, whether where is it going to make the most sense that the dollars are spent? Is it on the reinsurance side or the lower level insurance side? My gut tells me that it's the public insurer because that's where all of the pain is, right? The reinsurance is at the top level. Yes, it does impact your overall costs, but I would say that a majority of the costs that these developers and owners are facing come from the primary layers of insurance, simply because that's where the claims are getting paid, right? And so I think that in my opinion, right, risk mitigation, control the losses, those frequent type of losses, the kitchen fires and the water damage claims. My guess is that is where most of the premium is being driven, right, for these individuals. But that's just a guess, right? I think without looking at the loss data, we wouldn't know that.
Yeah.
So that would be my take on the public insurer versus a reinsurer. I think that there is, it makes some sense. And then maybe patients, just to give you an idea as to, and maybe David, this might be a question for you, right? The timing of creating a reinsurer or an insurer, right, is quite a long process in the sense of, all of the filings and the things and the capitalization. It's an 18 to 24 to 36-month process. And so if we're looking to follow patients, your comment of, hey, what are some of the short-term, mid-term, and long-term, right, strategies that we could deploy? I would say that the public insurer and reinsurer options are long-term. And maybe the risk management and funding risk mitigation efforts are the short term, right? And likely will have the most impact in the short term.
Agreed. What do others think? I'm seeing a suggestion from Jacob on 4, 5, 6, and 10, and I think that aligns with the upfront short-term priorities.
I appreciate Jacob's suggestions, and I fully agree. I think it's easier for all of us who are a little war wounded by the small digs. But I know that some of our other housing providers, luckily not, knock on wood, not yet, CRH has not had a major catastrophic multi-million-dollar loss. So I think it's important to remember that we are all war wounded by these small things, but it's those catastrophic losses that could put the nail in the coffin for an organization.
I agree. But could someone talk me through the public renters insurer piece, and how that would play out here without an existing public insurer? We would essentially have to, go ahead, David.
I would say it's a different mechanism of the same concept of two. Just instead, though, it's a little bit more boxed into the provider would still be using their own company, but then they would do either a subrogation claim back down to the state renter program to recover the funds that they spent if that entity was at fault for it.
Yeah, that's helpful. Well, in thinking about next steps, we are happy to get a draft letter that's beginning to circulate amongst the affinity group here. And maybe Lisa and Amy, the folks who joined today, can be a part of that engagement. And we can be in an iterative process of prioritization. But as the report lays out, I think it's important that we take many steps to get to addressing the issue. It's not going to be just one of this being done and we've solved for it. The other question, David, for you is, what will OIC's role look like going forward with the recommendations? My expectation is folks will continue to look to you to help unpack the report, unpack what the coordination of data looks like. But in terms of public insurer implementation, you are the regulator and not so much of the host of the public insurance.
And we actually don't really regulate risk pools at all. So that's the main entity that's providing coverage to these spots. So what would our role be? Advocacy. We know how important this is for the work that you do. Provide any additional information we can around the report. We can re-engage with our hired actuaries to see if there is something that maybe we missed, to go look at the data again. But you are operating in an insurance market that we don't really touch.
That's really helpful. We would appreciate the advocacy partnership,
Yep.
and Commissioner Kodora really cares about this work.
Absolutely.
So that poses the question of who pulls the letter together. Do we have a volunteer who can help us get a letter started to send collectively to the legislature over the next month or so?
I'm happy to participate, patients. Not the best ghostwriter, but I'm happy to participate in that.
Okay.
Yeah, I mean, I can't say we can commit to it in the next month, but I know Community Roots Housing would be more than happy to partner with Peter and others to try and address this.
Excellent. Any other volunteer or people want to be volunteered?
Jacob at Bellwether, I'm happy to assist as well.
Awesome. So we have Jacob.
Patients.
Awesome, thank you.
Who was that last person that just volunteered?
Amy.
Oh, I missed you, Amy. Yay. Thank you.
That's great. So we'll coordinate with the four of you in getting a draft started. David, we would appreciate being able to share a draft for review and coordination as we move the advocacy forward. And if there's any data needs, being able to tap you as a resource for that.
Happy to.
The other question, and Peter, you and I have talked a little bit about this, is there, beyond what the state can do, is there a collaborative enterprise or coordination that all of you as HDC members consider? I know there are organizations that are large and they have a risk pool already, housing authorities and others, but as organizations here locally who might be smaller, Is there a path for that, and how does HDC support that? And is there an interest for us to continue to think about that?
I would say, Patience, that if there is interest from the group, there is an ability to use the voice and the power of HDC's membership to potentially form an affinity group or some sort of purchasing group associated. And David, I'll kind of seek your opinion on this as well. Right, there are other nonprofit associations, contractors and whatnot that as part of a membership group are able to group insurance buying, right? And so the risk retention groups, and I'll just kind of expand on a little bit what David was mentioning earlier, and where most of you are buying insurance today are not in the standard world. The risk retention groups, historically, what we have seen from them is the more public housing and housing authorities that purchase through those risk purchasing groups. And so there are some restrictions, and David, I don't know if you could chime in here in regards to whether it's 100% public housing that is able to participate in those risk pools. In some cases, I think a lot of our developers here on the call today are low-income, Section 42 LIHTC deals where there are investors involved that will not allow them to participate in those some of those risk pools. So then you land into the surplus world, which is that third bucket that David was talking about, and that is unregulated by the state. It is the non-standard world, and that's unfortunately where this type of risk has landed, in the non-standard world. So is there a path or an opportunity to evaluate a insurance program for HDC members moving forward? Potentially. I think it'll be a lot of the same type of analysis that David has gone through with however many case studies and testimonials, and I don't know where the data came from, David, how many units, etc. But it would be a similar process to evaluate HDC members, those that are willing to share the information and want and have interest in us evaluating such a program for them.
So interestingly, back in the 80s, when there was a hard market for doctors to find professional medical liability, a group of Washington-based doctors got together and formed their own insurance company. And today it's called Physicians Insurance, and it's based in Seattle, and it is the state's top market share of med mal coverage in the state of Washington. So in these type of environments, maybe something that hasn't been thought of is to create your own insurance company. It takes $6 million in startup capital to form an insurance company. And so I know that sounds like a lot, but maybe not if we're dealing with all of the things that you are. So I'll just add in closing that one final idea is to form a housing provider mutual.
Yeah, David, are you referring to like a captive?
No. Talking about a straight up mutual insurance company. Okay. All you need is $3 million in operating and $3 million in surplus in Washington State to start it up.
You mentioned briefly captives was a fifth option for earlier, and maybe share with the group, or let us. I mean, the capitalization of a captive may be less than that.
Yeah, it might be. We don't regulate captives in that manner, so I don't have in this. Washington isn't a domiciled captive state, so the regulators in those states know much more about captive structures and stuff. So sorry.
Yeah, well, that's a great idea, David, and we've seen folks at the national level, the Housing Partnership Network has something similar to that for their members. So there's opportunities for us to learn from other markets what could be possible. But that'll be a huge undertaking, one that takes a lot of iterative conversations, but we're lucky to have board members like Lauren, who are also at the national level thinking about this. And Lauren, maybe LISC does an underwriting of the $6 million, sounds like a small chunk of change. And then we think about next steps.
I like that idea. Yeah.
Yes. All right. Well, just thinking about the next steps, we will coordinate on a letter, because I do think keeping this in front of the legislators is important. We will plan, though, Lisa and Amy, to bring this conversation continuously back to this group. I think this is a natural affinity group to continue to think about insurance and how we address that. And David, thank you for joining us and for your presentation. And with that, anything else logistically, Lauren, that we have not covered?
No, just
Well,
wrong Lauren.
Lauren, if you have closing thoughts, I would welcome them.
Nope, go ahead.
I'm just going to make a plug for the AMPM affinity group. We meet monthly on the first Tuesday from normally 1 to 2, although we've had some extended sessions. We also have been trying to have more in-person opportunities to meet and offer peer support. All of our subsequent meetings will take place at 12th Avenue Arts in the Pike Pine Room. But then we also will have a hybrid option for those who want to remote in. So great place to have these conversations. And thank you to Lisa and Amy for your leadership.
Thank you, Lauren, for all of your work as well. And thanks, everyone.
Next time.
Thank you.
Thank you.